Hi, and welcome to our weekly macro roundup. We talk macro, try to make sense of markets that really don't make any sense, and more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because today is History Day on the show. Not only are we going to finish up our three-part series on quantitative easing and look at actually the mechanics of how this works, we're going to go back to the Federal Reserve Act of 1937 and look at the origins of quantitative easing, where it came from, and then we'll look and see exactly where it is in the current Federal Reserve Act, where it is largely unchanged. So I thought you might find that interesting. But before we get into that, let's go ahead and start taking a look at the weekly economic data. With this being really a holiday week, between Wednesday and Friday, there really wasn't a whole lot going on in the markets. It's pretty normal that on Fridays before a three-day weekend, the traders go on vacation, which is odd because it seems like due to the coronavirus, all we've been doing is staying at home. So I don't know where they're going, but there certainly wasn't a lot of action in the markets really to talk about. So let's go ahead and jump right into the data. And here's the assets and liabilities at the commercial banks. Now, every Friday I'd like to look at this. It comes out at around 12:15 Pacific, and it's got some really useful information. So we can look at securities and bank credit and say, oh, wow, looks like the banks shed a little over $20 billion in Treasury securities the week ending May 13th. Now, this is really interesting because everyone says you need quantitative easing to make interest rates go down. And yet here's a week ending the 13th, rates went down that week and the banks sold off some of their bond holdings. So that's pretty interesting. We'll come back to this chart in a little bit, but let's continue on with what we've got here. So loans and leases in bank credit, we saw actually a decline about $5 billion. So that's kind of interesting. So this big surge in lending appears to be slowing down. Commercial industrial lending, after just jumping higher week after week, appears to be slowing down. Maybe this is a peak. We'll see in the weeks that come. Real estate loans slightly higher at $5 billion, but are definitely not making big moves here. It's pretty much flatline. How about the consumer? Because the consumer really tells us what's going on in the economy. Are we going to see this V-shaped recovery? Because in the data out of Europe and the preliminary factory data we saw out of the U.S., there's no sign of a V-shaped recovery. But maybe there's something in the consumer data, and we're not seeing that here either. So consumer loans dropped $4 billion, and credit cards down, looks like $3 billion. Auto loans flat. So nothing going on here in the consumer space that gives us any indication that we're about to see a big jump in economic activity. So let's take a look at some charts. The M2 money supply, the 12-month growth rate is up to 23.12%. Again, this is not due to quantitative easing. This is due to other mitigating factors, mainly commercial banks building up cash by borrowing money and investors moving out of risk assets to money market accounts. So we're going to see that this thing continues to rise, but the pace is actually slowing down. The monetary base is skyrocketing skyrocketing to 5.144 trillion, slowing down a little bit here. In the data, the 12-month rate of change is still astronomically high at 58.49%. We know Fed Chair Powell has been slowing down his pace of asset purchases over the last several weeks, but still the monetary base is rising. And the money multiplier is effectively flat for the last couple weeks at 3.5. We are in a deflationary mode. We will expect this to pick up because either Powell's going to increase quantitative easing at some point as we continue to see weak economic data and deflation, or we're going to see investors stop flowing money into money markets, or potentially both. So this party here is not done at all, but looks like a temporary pause. I looked at the monetary base data and it almost didn't seem like it was updated hardly at all from last week. It just seems odd that with quantitative easing going on that it's flat. So I wonder if we'll get some revisions in the next couple weeks and see where that data goes. Real estate lending growth is down to 4.15%. So despite some news this week that there's an increase in new mortgage applications. So this would mean people actually taking on a brand new mortgage, not a refinance, which makes you wonder, are people retiring, going out and putting an offer on a home and applying for a mortgage before they sold their house? Or is this some new demand? It seems odd with 25 million people on the continuing claims report from the ranks of unemployed, that would be the case, but the data is the data. It doesn't make sense to me, but it is there. The 6-month rate of change is down to 2.19. 3-month rate of change is 0.82% and falling. Again, showing very little demand in the real estate market. Looking at commercial industrial lending, we see this starting to appear to be peaking out. The growth rate flattened out at around 31.26% from a year ago. Again, as corporations are looking to grab cash to stay afloat, hopefully until the economy reopens and they can resume business as normal. But it's certainly appearing that business is going to be far from normal for quite some time. 6-month rate of change, 3-month rate of change is flat. Again, normally if you see this, it's telling you there's a big economic boom coming. In this case, that is not happening at all. Then loans and leases in bank credit, all commercial banks represent about 1/3 of all total lending, is flattening out around a little over 11% from a year ago. And 6-month rate of change is flattening and 3-month rate of change is rolling over, primarily due to the real estate market. And then coming back to the consumer, credit card growth rate down 5.85% from a year ago. We're hearing that delinquencies are starting to stack up in the credit card market and in the auto market, but this is just unprecedented in the history of credit card growth rate. So this is not good. This is telling us consumers are either delinquent, defaulting, or not spending, paying their bills down. So not good for the economy at all. So no signs of growth in terms of a V-shaped recovery in at least last week's economic data. All right, so let's move on to History Day. So I think it's important to know, if you're wondering what I'm looking at, I'm trying to get the next slide lined up while I alt-tab through a bunch of screens, annoyingly to myself, is where does quantitative easing come from? Now, back in 1930, this was the beginning of when the Fed did what we now refer to as open market operations, where they actually did buy treasuries because they lowered the federal funds rate. It wasn't working. They tried this. It really didn't do much, as we know, and we've been learning over the last couple of weeks that quantitative easing does far less than what most people actually think it does. So I want to take you back to the origin so you could see where it came from and then how the Fed sort of twisted this thing into how we use it now, because it wasn't really intended. The law, when you look at it, you'll see it wasn't intended to be used the way it is used by the Fed today. But because it was a law, the Fed found a way to, just do the opposite of it. So let's take a look at this. Is the Federal Reserve Act of 1937. And you can see here, Federal Reserve Act Amendment, and the date, March 1st, 1937. And I will show you where this comes back to in the current act, which we can go see, and we'll go look at shortly. But that is in, where is it? Somewhere in here it says, here, Section 16 of the Federal Reserve Act. So I'll show you where that is on the Federal Reserve website. So let's take a look at this. It says any Federal Reserve Bank may make application to the local Federal Reserve agent for such amount of Federal Reserve notes. Now, what do they mean by Federal Reserve notes? Cash, greenbacks, dollar bills. Hereinbefore provided for as it may require. Now, you have to understand the concern when they passed this law was the banks, they had bank runs. They needed cash. So Congress is trying to give the Federal Reserve the power to deal with cash shortages. So that's what you're seeing here. Let's continue on. Such application shall be accompanied with a tender to the local Federal Reserve agent of collateral. Whoa, what's this? Collateral in the amount equal to the sum of the Federal Reserve notes thus applied for and issued pursuant to such application. So to make sure that this wasn't money printing, because it could be, right? Hey, Federal Reserve Bank, I need a bunch of cash. Oh, here you go. Well, that's printing money. So no, they said you have to post collateral back. And what happens if you don't repay Those notes, well, the collateral becomes a property of the Federal Reserve. We'll get to that in a minute. So let's go on. The collateral, security, thus offered shall be notes, drafts, bills of exchange, or acceptances acquired under the provisions of Section 13 of this Act, or bills of exchange endorsed by a member bank of any Federal Reserve district. Keep in mind, collateral security. And purchased under the provisions of Section 14 of this Act, or bankers' acceptances, or gold certificates. Now, let's get on to the interesting part. Provided, however, now mind you, this was never meant to be a long-term solution, which it is now, but it was at the time it was not intended to be. That until June 30, 1939, the Board of Governors, which we refer to as the Federal Open Market Committee, which Jerome Powell is the chair of the Federal Reserve System, may, should it deem in the public interest, how about that, upon the affirmative vote of not less than a majority of its members, authorize the Federal Reserve banks to offer and the Federal Reserve agents to accept as such collateral security direct obligations of the United States. That is, and we will look to understand that to mean U.S. Treasury securities and mortgage-backed securities. And then they go on to kind of the terms of how that all works. So we now understand that this relationship was a collateral loan. The banks needed cash to deal with the potential run on banks. But the Fed said we can't print money. Congress said you can't print money because look where this comes from. This comes from the 75th Congress. So Congress makes the rules here. They're making sure this is not printing money. It's collateral. Now, what would happen if the banks didn't repay that collateral? What would happen? Well, as whatever the collateral the Fed had matured, because it appears to be loans and whatnot, they would destroy the money. Now, today, we destroy it by computer entry because it's digital. Back then, if it was physical money, they would have had to destroy it. And by same token, when they received that money back from the banks, what would the Federal Reserve have to do with it? Well, they would have to destroy any access that they didn't need. So let's expand upon how this collateral relationship works. Because what the Fed is doing today is just the complete reverse of that. Rather than banks coming to the Fed and say, hey, we need some money, and here's some collateral. Now the Fed is coming to the banks and say, I need your treasuries. I'm going to give you some collateral. So let's use an example. Let's say I'm going to go on a trip this weekend out of town. We'll assume the world is normal. And I want to take a bunch of pictures, but I don't have a digital camera, or maybe mine broke or something, but you have a really good one. So I come to you, my friend, and I said, friend of mine, can I borrow your digital camera? And you go, well, yeah, but it's a really expensive model, and I'm not overly comfortable with that because I if something happened to it, I need it for work or who knows, whatever. And I said, tell you what, I've got this 1 ounce gold coin, and I think that's about the value of your camera. You say, well, yeah, as a matter of fact, it's about the same value. I said, well, why don't I do this? I'll give you this 1 ounce gold coin in collateral for the camera. And you say, well, that seems like a reasonable deal. Now, is that gold coin yours? No, it's mine. It's titled to me. I'm just giving it to you to hold on to. Is the camera mine? No, it is still yours. It's just in my possession. Now you say, Steve, I really don't feel comfortable holding on to your coin. So we get a friend of ours who is a very secure person, has a big safe in their house, and we bring him over and say, hey, here's the deal. I'm going to borrow my friend's camera here. I'm posting this gold coin as collateral. If I do not return it at the end of Memorial Weekend, Monday night at say 8 p.m. to him, this coin is his. And we're asking you to keep it in your safe. And he says, fine, no problem. I'll be happy to do that. And so he takes the coin. Now tomorrow, can you call him up and say, hey, that Steve guy's pretty unreliable. I doubt he's going to bring that camera back. And if he does, it's probably going to get ruined. Can I have the coin? No, it's collateral. So now let's finish this out. I come back Monday from the trip. I meet with you before 8 p.m. I hand you your camera. You inspect it. It is to your satisfaction, not a ding, dent, scratch. It's perfect as you gave it to me. The gold coin is then returned to me. It is still my property. Now let's say I come back and say, hey, you're not going to believe this, but your camera got stolen. Now, does that mean the gold coin automatically becomes yours? No, it's posted as collateral. So then I say, hey, you know what? I feel real bad about this. I am going to buy you a brand new identical model of that camera. And I've got it on order. It'll be here in a couple of days. And you say that's acceptable. And then I replace your camera with a brand new one. Where does the gold coin go? It comes back to me. Now let's say I can't afford to replace your camera. And I say, hey, I tell you what, I'm not in a position, I can't get the money soon enough. So I'll tell you what, I am now going to release the gold coin to you as my posted collateral. Now who does the coin belong to? It belongs to you. So look at what the Fed is doing. They're going to the large commercial banks in an auction format and saying, we need to buy X number of treasury securities and mortgage-backed securities today. Are they buying them or are they really borrowing them? It seems kind of weird, doesn't it? So the banks bid on it. Obviously, the Fed's going to take the low bidder. And then after they receive the bonds, the treasury securities and mortgage-backed securities, they post collateral in a bank account at the Federal Reserve member bank. Now, can the commercial bank go to the Fed bank and get the collateral? No. Who does the collateral belong to? The Fed. It's not money printing. So if those bonds are not eventually returned to the banks, then the collateral would get paid out. It's like an insurance policy. That's why this isn't money printing. The banks do not receive anything. Now, they might get something in the meantime. I know there's a way the banks somehow make a little bit of money on this, but they do not get the value of the bonds. It goes and posted as collateral in a bank account. How do we know that? Because we see the word collateral printed all over this. Otherwise, it would be money printing. Because if the Fed gave the banks money for the loans, now we would have money printing. So the question is, well, where does the banks get that money from? Or the Fed get the money from, not the bank. Where does the Fed get the money from? Well, the Fed has the power, the legal authority to create money. So they make a computer entry that says, well, we need to buy $5 billion. So we now have creating $5 billion. We're going to go buy these securities and take that $5 billion that we just created moments ago and post it in a collateral account that cannot be withdrawn from. The problem is the loan for these treasury securities appears to be potentially indefinite. But again, that money that is being posted as collateral doesn't get out in the economy. It's no different than that gold coin. If I gave it to you for safekeeping, you could not sell it. It's not yours. You could not spend it. It is not yours. You couldn't swap it for something else. Say, hey, Steve, I know you're giving my camera back, but I traded your gold coin for something else. I thought you'd like this. You don't have the legal authority. It's not your coin. You don't own it. In this case, the same is true here. The money posted in that account belongs to the Fed, not the banks. It's posted as effectively collateral. Now, where do we see that? Well, this is key because, remember, it's in Section 16 of the Federal Reserve Act. Well, here's the Federal Reserve Act on the Federal Reserve website, and here's Section 16. And here's all that language, just kind of, over the years of amendments, but it's pretty much the same thing of what the Fed can do. And if we take the word collateral, you can see it's printed all over this thing. The Fed is just doing the reverse of what the law was intended to do. They have literally stretched this thing to the limit. But here it is. You can see purchase under provisions said 14 or gold certificates or any obligations which are direct obligations or fully guaranteed as to principal and interest by the United States or any agency thereof, or assets that Federal Reserve banks may purchase or hold under Section 14. There you go. So the Fed has the power to accept as collateral. So all they're doing is just the reverse of this. That's all it is. They're just reversing the law. So it's legal. but they're not printing money because the money never gets back in the hands of the commercial banks. They're posting it as collateral. Now, the Fed does have the ability to buy an unlimited amount of Treasury securities. Now, why are they granted this? Well, they're granted this under Section 14 of the Federal Reserve Act to buy and sell in the open market under the direction and regulation of the FOMC any obligation, which is a direct obligation or fully guaranteed as to principal and interest by any agency of the United States. So by law, the Fed has the authority to by Congress. They granted this power by Congress without congressional approval to buy or sell as much of the stuff as they want. It's not money printing. So if China wanted to dump all their things, technically the Fed could buy it. They're probably going to route it through the banking system, so it's not money printing, but they can create enough digital credit currency to go to the bank and say, look, you buy everything they're selling and we will buy it off of you. That's how it works. And now you can see it in the Federal Reserve Act. It's right there. Now let's go to my crudely done PowerPoint slides and look at the mechanics of how this works. So here we have the commercial banks are buying U.S. government securities with cash. Now, where do the banks get their money to buy cash? Well, one, they are lending institutions, so they could say borrow against their deposits. Banks are allowed to create money out of thin air. They do have revenue that comes back off of their loans in the form of interest. So they can go out and buy Treasury securities. And mind you, they have to. By regulation, they need to hold them. They need them to back loans. They need them to do all kinds of things. And they don't go to the auction. Only people go to the auction are domestic investors, foreign investors, or mostly foreign central banks, and securities dealers, which conveniently in this case happen to be owned by the large commercial banks. And where do they get them? Eventually, they get them from the U.S. Treasury, who auctions them off, and they go to, say, the securities dealers, who will presume the commercial banks buy from rather than directly out on the open market. So that's how they get them. Now, what can the banks do with the U.S. Treasury security? Well, they can do lots of things. They can hold it and collect the interest. That's fine. They could just sit on it as an asset for use later on. They can lend it to speculators. Now, what would a speculator want to do with the Treasury security? They would want to short it. Why would they do that? To drive interest rates up. So the bank could say, hey, we're going to hold on to it, and in the meantime, to make a little extra money, we're going to lend it to speculators and make some extra money who we already know are going to short the bond market. They could sell it to raise cash. Maybe the bank needs some cash. They could sell it on the open market, or they can use it as a collateral for a loan. So when you go out and get a 30-year loan, guess what the bank's got to back that loan with? A 30-year bond. You with me so far? Good. So the bank can do lots of things with this. Now the Fed comes along and says, hey, we need to do something called quantitative easing because things are bad and we need to do some QE here. So the Fed's going to buy the U.S. government debt from the banks with cash. Now the Federal Reserve can conjure up cash out of thin air because they are the people that make the currency. So they create some digital currency and on their computer screen, and they go to large commercial banks and force them to sell it to them. They have no choice. The Fed comes along and says, we are going to sell it to you, which actually looks like they're just borrowing it, but nevertheless, a price is established. No different than in our example before, where we established a price for the camera, which was approximately equal to the gold coin. So a price for these are established. Now, that exchange happens. And here's the new exchange. Well, wait a minute. Okay, the Fed now has a U.S. Treasury bill, note, or bond, and a large commercial bank has technically $1,000 in cash. Or do they? No, they don't. They don't. So is everyone really happy? Well, the banks now have an account that they can't access with the money in it. And here's Fed Chair Powell. Look, I had liquidity. Yay, the stock market is saved. Everybody's happy. I'm the hero. Okay, so are the large commercial, see, I told you these were crummy graphics. So the cash is held in collateral, or the cash is collateral held in a Federal Reserve member bank. Banks give up cash for a worthless deposit account. They can't touch it. They can't withdraw the money. It's not theirs. They can't go, now they can lend, they can use it as an asset to lend against, but they have to risk their own capital. They can't take the money out. They can't use it. So cash leaving the financial system to get tied in an account that can't be withdrawn from, well, that's deflationary. See, banks can lend against the cash and collect the interest off it, but that's it. It's collateral. That's it. They can't do anything with it. Does it make sense? So here we go. Quantitative easing is not inflationary. It exchanges treasury securities and mortgage-backed securities for cash that can't directly enter the financial system. Hence why it is deflationary, even though everyone believes it does something when it really doesn't do anything. So what does it do? Well, we got to come back to what the banks can do with it. So let's kind of look through some of these. Now, if a bank were buying bonds and holding onto them, would it have any impact on the markets? Well, arguably it would cause interest rates to go down. Now, how about what if they said, you know what, we're going to lend this to speculators who are likely going to short it, because why would a speculator borrow it to keep it? That doesn't make any sense. So speculators are going to short it. That's going to drive interest rates up. But if the Fed is taking this off of the bank's hand, then they can't lend it to speculators or lend as much of them. So one thing you can think of, as I've said before, is the reason the Fed initiates the largest short squeeze against the treasury market is because as the banks run or have fewer treasury securities to lend to speculators to short, well, eventually the speculators get squeezed out of those positions due to the Fed. And here we've seen already, because we look at this every Monday, deeper and deeper deep short positions in the U.S. Treasury market. Well, the bond interest rates aren't moving. So that means speculators need to short more. But if the Feds come along like a Pac-Man, chomp, 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 it's leaving them less and less bonds to short. So they can do that. The banks could sell them for cash. Now, what would happen if the banks started selling a bunch of their treasury bonds and the securities in the market? What would interest rates do? They'd go up. So we have interest rates probably go down or stay flat. Lend to speculators, interest rates go up. Sell for cash, interest rates go up, or use it as collateral for a loan to make money, so that would mean they'd hold on to it. So what does quantitative easing do? Well, it means the speculators have less access to bonds to short. It means the banks can't sell it for cash. So the two things here that would cause interest rates to go up get removed. How about use it as collateral for a loan? Well, if the banks don't have as much collateral for loans, guess what happens to lending standards? They tighten. Do you see what this thing does? It tightens lending standards, and then banks are like, hey, you know what? We can't do as many mortgages because the Feds come along and gobbled up all this stuff. So why do they raise lending standards? Because they still want to do loans, but they can't do it for everybody, so they start cherry picking the high quality credit customers. Now, what about that cash sitting over in these collateral accounts? What does it do? Well, it piles up. And technically, it kind of belongs to the banks, but not really, because it's really the Feds. But what does cash in the financial system do to interest rates? Think about this. What if your bank was piled full of trillions of dollars in cash? Are interest rates going to go up? No, they go down. When there's cash piling up, interest rates go down. Hence why QE tightens lending standards, causes interest rates to go down, and squeezes speculators out of their short positions given enough time. Now, when you look at this from a charting perspective, and we look at what's going on in, say, the 30-year Treasury yields, let's zoom out, all this QE that everyone thinks is supposed to send interest rates up hasn't done anything. In fact, since 2018, interest rates have been generally in a downward pattern. And we've had QE all through here. Why aren't interest rates going up if that's what it does? Because it doesn't cause interest rates to go up. In fact, QE really doesn't appear that it's done anything. Look, the bond market has gone sideways. I said interest rates would go sideways until 30-year Treasury will break 1.2, and then it's usually headed down. Almost got here, but didn't happen. But look, QE had no effect. None. Even in fact, the banks selling bonds last week really didn't do anything. So QE does a whole lot less than everybody thinks. And now you can see the mechanics of it and know that it's not money printing. The Federal Reserve Act just clearly states repeatedly that it's using it as collateral. All the Fed did was take that 1937 law and do it in reverse. It was never really intended to do that, but we do it now. So now you know. So let's take a look at a few charts while we're here. So we see Treasury yields continuing to head sideways. This is a consolidation pattern. Now, what I find interesting about this is I thought we were headed to zero when this move happened, it didn't. But it goes to show that somebody, the smart money, thinks there's enough money to be made that they're buying treasury bonds all along the way here. As we know, speculators have been heavily shorting them. That tells you that they think there's money to be made and this trend is not over. Consolidation patterns, when you see these sideways patterns, is generally a continuation of the predominant pattern, which is lower. Now, if this was a bottoming pattern, we're more likely to see, say, a double bottom, a move down here, a retest of the lows, or something similar, perhaps even a third test of that before it takes off. So for now, this is consistent with a bottoming pattern. Now, we can look at the almost mirror of that, TLT, which is the largest 20-plus year Treasury bond ETF. And we can see today it crossed back over its 50-day moving average. Again, the Fed's backing off its quantitative easing. Everybody said this thing should be going to the floor. It is not. It doesn't work that way. The Fed is just another buyer in the market. But there's multiple factors that move Treasury yields around, and it's not solely up to the Fed. But what we can see right now, it held this lower bound of roughly 1.4% here, held it again here, following the channel, which says that some point, a retest of this, which is approximately 1.2% up here. If we get a sustainable break over this, I think we see that big bond bull market break out and yields head to zero. How about emerging markets? My proxy for liquidity. It got into Steve's line of doom, and what happened? Well, it failed. And so again, as I look at this and say, do I still believe Treasury yields are headed lower? Yes, because emerging markets are not showing there's liquidity. How about the dollar? Dollar is clearly range bound, moving in, again, a consolidation pattern. What is likely direction for the dollar? Well, the dollar's been trending up. Consolidation patterns usually follow the predominant trend. We know there is a massive dollar shortage, so it is highly likely that we see the dollar head higher. And if you look at this and invert it, you'll notice that it's generally following an inversion of Treasury yields. But the U.S. dollar is not always perfectly inversely related with Treasury yields, so you don't think that, but it does have a relationship with it, but is not perfectly correlated. So that's interesting. So everything's still telling me financial conditions are tight. Obviously, with all the people on unemployment and businesses failing, it tells you a lot of things. And it's amazing what you can see sometimes just by going out in the economy. And before we wrap up, I got a quick story for you. So my dry cleaner, he actually turns out he's one of my neighbors. He has 3 locations in town, and I use obviously one closest to my office. Well, I went in there yesterday to take my dress shirts in, and the gal there said, oh, by the way, as of next Friday, this location is temporarily closed. Right, temporarily. So she said, you need to come back or your stuff's going to get transferred to one of the 2 locations before we close. No problem, I'll do that. The reality is that location is probably going to be permanently closed. But think of it from, the landlord. They're probably not going to get rent on it anymore. How about electricity, water, wages, supplies, all the things that go into that location creating economic growth, going to zero. So it tells you he wouldn't be closing that location temporarily, likely permanently, if things were going that well. All right, so I'm going to wrap up now, and I'm going to, once I get all this done and uploaded, I'm going to do the Marathon Monday video. I'm going to prepare you up front. It's going to be very long. I have 25 pages of 15-point font worth of questions. I had no idea it was going to be that long. So I have a challenge for you, because obviously I'm going to invest a lot of my time because you supported me. I want to thank you. Going forward, though, we need to determine if if a Q&A video is even reasonable. Now, I realize this one's going to be probably longer than it should be on an ongoing basis. The channel is running about 1,500 views-ish of video. If I see a big drop off on video views on that one, and normally I don't really care about this. This is more of investing my time in answering all these questions. If I see a big drop off from that video, I'm probably going to start cherry picking questions. If we maintain somewhere in the range of what video views are, then that's confirming to me that this is the kind of content that you want. So if you want me to continue answering your questions and you want me to build that in, maybe once a month I'll do a Q&A video, or once I see the backlog gets too much, I'll do one and keep them shorter. Then get the word out, get people watching it, be engaged with it, and I'll continue doing it. So I will also try to release it earlier on Monday due to its extreme length. So I hope you enjoy it. But again, I'm going to answer all your questions I'm anticipating. It's probably going to be an hour long or more. So I hope you enjoy it. I hope you have a great weekend, and I will be back with you, of course, pre-recorded as normal, but on Monday, and then we'll catch all things back up on Wednesday as we normally do. I'm Steve Van Metre. Thanks for watching. Appreciate you being here, and I hope you enjoy the Monday special coming on Monday. The content of this video is provided as educational information only, is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by or selling security, financial product instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video of that alone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.